watching Big Brain Energy.
Kia ora koutou. Today we're going to look at a past paper for the Market Equilibrium External. This is the NCEA Level 3 External 3.1, Demonstrate Understanding of the Efficiency of Market Equilibrium. This is an exam at the end of the year which is worth 4 credits. Honestly, the questions that you get given in this exam are quite predictable, which is really good because it means that you can pretty much just memorize some model answers for the typical types of questions that they ask. In this external, there are basically just a bunch of different graphs you need to know, and each of the 3 main questions are going to be focusing on a different graph. For each of those graphs, you need to know how to draw the graphs, how to shade and label the producer and consumer surplus, as well as any deadweight loss and the impact on the government. And then for each graph, you typically get asked a question where you have to explain the effect on consumers, producers, the government, and allocative efficiency. So if you know how to do that for all of the graphs that you could be asked about, then you've set yourself up really well. On our channel, we have in-depth videos for each of those graphs where we go over everything that you need to know for the exam. So let's start with a skim of this whole paper. This is a 2025 paper. The first question is all about tax. So you've got a couple graphs there that you have to draw in, and you have to draw in the consumer and producer surplus, tax revenue, and deadweight loss. And then there are some explanation type questions where you have to compare different elasticities, and then in relation to the government. The next question is about tariffs. So there's another graph there where there's a situation happening that it tells you about, and then you have to draw the impact on the graph. You have to shade and label the new consumer surplus, producer surplus, tariff revenue, and deadweight loss. And then there are some explanations where you explain the impact on consumers, producers, the government, and allocative efficiency. And then the final question is about subsidies, where again it's given you a situation and then you've got to draw the subsidy graph and then explain those changes. And then you have to explain the impact on consumers, producers, the government, and allocative efficiency. So that's all the questions in this particular paper. The interesting, though perhaps annoying thing about this exam is that they only ask you 3 or maybe 4 of the graphs that you have to learn. So there's a few graphs that you have to learn, but you won't get asked about all of them. So you can see that in this paper there's no questions about minimum or maximum price, yet that's something that they could have asked you about. So you do need to learn all the graphs, but you won't necessarily get tested on all of them at once. So let's go through the graphs now. We're going to type up a model answer for each, and we'll go through in depth so that you can see how we got those answers and exactly what they're looking for to achieve the grade that you want. We'll talk about exactly what the marker wants to see when they mark, and also talk it through to try and help you understand what exactly everything means. Alright, so question 1 is all about tax and elasticity. It says that the purpose of an indirect tax, such as an excise duty, is to discourage the consumption of goods that may have negative or social impacts, and to generate revenue for the government. The types of taxes that we talk about in this external are all indirect taxes. It's only excise taxes, which is a special tax, placed on a particular good or service. Generally, it's used to discourage the consumption of something that is bad for you, like maybe cigarettes or alcohol or something similar. So this is different to a tax that you pay on your income, or it's different to a tax that a business might pay, and it's different to GST. It's its own separate thing, and that's the only tax that you have to worry about in this exam. Graph 1 shows the effect of an indirect tax placed on a good with inelastic demand, and Graph 2 shows it for elastic demand. So inelastic demand is something that a change in price results in a proportionately smaller change in quantity, and the curve is steep. So you can see on Graph 1 that the demand curve is really steep compared to Graph 2, where the demand curve is a lot flatter. So elastic demand curves are flatter, and a change in price results in a proportionately larger change in quantity. Inelastic goods, which are things like necessities, for example, like petrol or rental groceries, and elastic demands are things that, for example, aren't necessities, like maybe luxuries, like going out to the movies or going on holiday. You can see that on the graph, the decrease in quantity for the inelastic demand is quite small, whereas the decrease in quantity for the elastic demand is quite big. So that's what we're talking about there when there's differences in the proportional changes in quantity. Alright, so the question is saying that there is a tax placed on these 2 different goods. The tax that is placed on them is the same, and the only difference is that one has inelastic demand and the other elastic demand. The first question says complete table 1 below by using the labels in graph 1 and 2 to identify the changes in surpluses, government tax revenue, and deadweight loss. Alright, so first I'm going to go and make sure that these graphs are a little bit clearer. We've got the initial supply and demand, and then we're going to add in this tax curve here. The tax curve is always a parallel line to the supply curve and on its left. A tax makes something more expensive for the consumers, so the original price is PE, that's the original equilibrium price, and then the price that consumers pay now with the tax would increase. So on the graph, it is increasing to P1 on graph 1, and then on graph 2 it increases to P2. The price that the producers receive decreases. It decreases on graph 1 from PE to P3, and on graph 2 from PE to P4. It decreases because the producers pay part of the portion of the tax. So basically what happens with the tax is that the government tells the company, like maybe let's pick an imaginary item for what this is. Graph 1 is looking at, say, cigarettes. The government tells the cigarettes company, hey, we're going to charge a tax for every pack of cigarettes that you sell, and you have to make sure that you pay an extra $2 whenever you sell a pack of cigarettes. It's now up to the cigarette company to decide how they want to fund the money for the tax. They could either make the consumers pay an extra $2, or they could just pay an extra $2 themselves. Or they could split it between both of them. And usually they do a bit of both, and this is what we can see going on here. So part of the tax is paid for by the consumers, and part of it is paid for by the producers. And that's why the price increases for consumers, and at the same time, the price received decreases for producers, because they both bear the burden of the tax. You can see that what is interesting here is that there's a really big increase in price for the consumers for inelastic demand, and a pretty small decrease in price for producers. So what's happening here with the inelastic demand is that consumers are paying most of the tax themselves, and then the producers is only taking on a small burden of it. Whereas for the elastic demand, there's a small increase in price for consumers and a large decrease in price for producers. So the opposite is true here, where we've got the producers taking on most of the burden of the tax, and then the consumers don't pay much of it. If you ever get given a question in the exam where the graphs look a little bit confusing to you because they're using maybe different labels to what you're used to, you can always just draw in the normal labels that you work with, like we've done here, and you're allowed to take in highlighters and coloured pencils into the exam if that makes it easier for you as well. Alright, so let's get back to the question. Now we have to shade and label the decrease in consumer surplus for both of the graphs first. The original consumer surplus would go from the amount that the consumers are willing to pay, which is the demand curve, down to the amount that they actually pay, which would have been PE. Now though, the new consumer surplus goes from the amount that they're willing to pay, so that's still the demand curve, down to the amount that they actually pay, which is now P1. So consumer surplus has decreased by P1, AB, PE. This area here was part of the consumer surplus, but now when the tax is added, it's not anymore. For the elastic demand, it's going to be the same area, so on the graph it is P2, EF, PE. In the exams, there are a few different ways that they might ask you about the graphs. Either they'll give you actual numbers or they'll give you letters like they have here. They can also either ask you about identifying the new surpluses or identifying the change of it. And they'll either ask you to shade and label on the graph or to identify the area by saying the letters, like in this case. Or if they give you actual numbers, they might ask you to actually calculate the value of those areas. Okay, so looking at producer surplus now. The producer surplus originally before the tax was the difference between what producers are willing to sell for, so that was the supply curve, up to the price that they actually sell for, so that was PE. Now though, it is the difference between the price that they are willing to sell for, which is still the supply curve, up to the price that they actually receive, which is P3. So the change, the area that has decreased, is PE, BC, P3. And then for graph 2, it is PE, FG, P4. The tax revenue is going to be the full price of the tax, so that's going to be the difference between the price that producers receive and the price that consumers pay. So it's going to be the difference between P3 and P1, and then it goes all the way out to the quantity that is sold, which is Q1. So for graph 1, the tax revenue is P1, AC, P3, and then the same for graph 2, so P2, EG, P4. So the tax revenue is always a box like this, so it's the extra tax that is paid, and it goes out to the quantity that's being sold. That is the money that the government collects and keeps for itself. Sometimes instead of tax revenue, they'll say government revenue. That's the same thing. And lastly, the deadweight loss. When there is a tax, the deadweight loss is area A, B, C, and area E, F, G. So this area here used to be part of the consumer and producer surpluses, but now it's not. It's also not part of the tax revenue. So basically, no one is benefiting from this amount. It is potential that could have been benefited from because originally before the tax, the consumers and producers were benefiting from it. It was part of their surpluses. But now it's not part of anything. So it's potential that is lost. It is deadweight loss. So looking at the marking schedule, it says that we've got all the labels there correct. If you get all of them correct, you get merit. And if you only get 6 correct, then you get achieved. So if you get a couple wrong, that's all good. You still get some marks for that. Okay, so that's everything for question A. Let's move on now to the explanation question. With question BI, it says refer to graphs 1 and 2 and table 1. In your answer to part B below, explain why the impact on a consumer surplus is greater when demand is inelastic compared to when it is elastic. In your answer, include the definition of inelastic demand and a reason for demand being inelastic. So if you were completely lost and didn't know how to answer this question at all, a good thing to do would be to pick out the keywords and just define those. So it says consumer surplus, so you could just write down the definition of consumer surplus. And it says inelastic and elastic demand, so you could just write down those definitions too. That might get you at least a few marks. And it might also, more importantly, spark some ideas to help it click and think, oh yeah, actually maybe this could be the answer to that question. The way the marking schedule is laid out is that typically you just answer the question and then that gets you achieved. And then if you answer it with a bit more detail, then that gives you merit. And then if you include all the relevant detail, including linking to the graph and using the keywords that they want, then that is excellence. Okay, so when there is a tax imposed, consumers are worse off in both situations. Why is that? Well, they need to both pay the tax, so they both pay a higher price, and they also decrease the quantity that they buy. So in both situations, when there is a tax, consumers are worse off because they have to pay more and they buy less. So that's not so good for them. Now, what you want to do whenever you write your answers is refer back to the graph. So we say a higher price, so let's refer exactly to the graph, what we're talking about here. So you can say for inelastic demand from PE to P1 and for elastic demand from PE to P2. And then the same for the change in quantities. So for inelastic demand, quantity decreases from QE to Q1 and for elastic demand from QE to Q2. Now, there is a sentence that you have to write to get excellence, and that is the difference between what consumers are willing to pay and actually pay decreases, and there are less units from which to gain a surplus. So we said that they pay a higher price and they decrease the quantity. If they pay a higher price, this means that the difference between what they are willing to pay and actually pay decreases. And if they're decreasing their quantity, then there are less units from which to gain a surplus, which means there are less opportunities for consumers to benefit because they're buying less stuff. So there's not as many opportunities to get a surplus or to benefit. So that sentence there, that's what they want you to say to get excellence. So overall consumer surplus decreases, and again, let's link that back to the graph. So we can say for inelastic demand, it decreases by P1 ABPE, and for elastic demand by P2 EFPE. Cool. So we've said that so far consumers are worse off in both situations. Let's now talk about which situation consumers are impacted by more. So even though the tax is the same amount for each good, consumer surplus actually decreases by a larger amount when demand is inelastic. If you look back at the graph, the area that consumer surplus decreases by is larger for the inelastic demand than it is for the elastic demand. And let's write in exactly what that is, P1 ABPE, which is greater than P2 EFPE. So why is that? Well, when demand is inelastic, there is a large increase in price for consumers and a proportionately smaller decrease in quantity demanded. So if you look at the graph for inelastic demand when there is a tax, price increases for consumers by quite a lot, PE to P1, whereas for elastic demand it only increases a small amount. Also, quantity decreases by quite a small amount, QE to Q1, compared to elastic demand. But that's not really as important as the price change because it's only a small amount, the consumer surplus, that gets taken off there. So basically, the overall change in consumer surplus is bigger for the inelastic demand than it is for the elastic demand because of the fact that when something is inelastic, there's quite a big change in price. So in the question, it's said to include the definition of inelastic demand. So that sentence there was the definition of inelastic demand. And then also to include a reason for demand being inelastic. So we could say something like, for inelastic goods, for example, goods that are necessities or goods with few substitutes, then when price changes, most consumers just keep buying it anyway, because if it's a necessity, then they just have to buy that regardless of the price. Or if there's no alternative, then they also just have to buy that, regardless of the price. Like, for example, petrol. When petrol gets really expensive, like it has recently, we still have to buy it, right? Most of us, sure, some of us will spend a little bit less on petrol, but most people tend to have to buy it anyway. They have to get to work somehow. So even when price of petrol increases, quantity demanded may decrease, but not by a huge amount. So we say that there is a proportionately smaller decrease in quantity demanded compared to the price increase. Now, it didn't say to do this in the question, but it's always a good idea to talk about the other side as well. So for an elastic good or service, so that is something like a non-essential or a good with many substitutes, then when price increases, quantity demanded decreases by a proportionately larger amount. So that's the definition of elastic demand. Let's go back now and actually answer the question. It's always good to include a concluding sentence here at the end to make sure you've actually covered everything. And that's it. That is absolutely everything you'd need to include to get excellence. Let's compare this answer to the marking schedule. So the marking schedule for BI, you can see it has an example answer there of how you could write it. And then along the side there it says the things that you need to write for achieve merit and excellence. So to get achieve, you have to say that the consumer surplus decreases due to the higher price, which is what we said, or the lower quantity. So you're just saying price or quantity changing, just saying either one gets you achieved. To get merit, you'd say both. There is a higher price and there's a lower quantity. And then you'd also say consumer surplus decreases when demand is inelastic. So you're saying which one is actually decreasing more. And then to get excellence, you can see that you just have to add in that extra sentence there, using the words that they like you to use, which is there are fewer units from which to gain a surplus. Or you could say the difference between the price consumers paid and are willing to pay decreases. So actually you only need to say one of those things in this instance. Sometimes they'll say and for excellence here, so it's always best to include both. Okay, and then the second point you need to make is when demand is inelastic, this is for achieved, a price increase leads to a smaller than proportional decrease in quantity demanded or some other valid reason for inelastic demand. For merit, you'd say all that, and then you'd also say a valid reason for inelastic demand. So that was our definition of inelastic demand that we included in the answer, and then also a reason for why something might be inelastic. And then to get excellence, you just need to say consumer surplus decreases more when demand is inelastic, with some kind of definition of inelastic demand and also why it might be inelastic. And then you also have to say the price that consumers pay increases proportionately more for the inelastic good than the elastic good. So you can see that to get excellence, you kind of just have to include all the points, whereas if you just include some of the points, then you get achieved, and if you include somewhere in the middle, then you get merit. So it's a good idea to try and memorize everything for excellence, and then you can aim for that in the exam, and then if you kind of, freak out and you don't know what to write, you can just write all the things that you remember, and then you'll hopefully get at least merit, but if not, then at least achieved. Okay, and then for the last question within this section on tax, it says explain whether the government would place an indirect tax on the elastic or an inelastic good if the objective was to generate revenue, and then if the objective was to discourage consumption. So with both instances, the government collects a tax revenue, but they actually collect more with the inelastic demand than with the elastic demand. So if we go back to the graph, you can see that now looking at the changes in quantity decreases by only a small amount when a tax is placed on an inelastic good, whereas it decreases by quite a large amount for the elastic good. So if people aren't buying as much of something with the elastic demand, then the government doesn't collect as much tax revenue. Because remember, this isn't just like a fixed amount of tax, it's a tax on every item that's being bought. So if this is cigarettes, so they're saying every pack of cigarettes sold, you pay $2 tax. So if you want to get more tax revenue overall, then you have to sell more cigarettes. So with the inelastic demand, there is more cigarettes being sold. Therefore, the tax that can be collected by the government is more. And then, of course, we want to link it back to the graph. So let's write in the areas that the tax revenue represent. So that is P1, AC, P3, and P2, EG, P4. And then let's explain that this is because when demand is inelastic, the decrease in quantity demanded, so that is QE to Q1 on the graph, is proportionately smaller than the increase in price, since for both the change in price is the same, which is saying that the tax is the same for each situation, so the change in price doesn't actually matter. So we just have to look at the quantity. So therefore the option which has the smaller decrease in quantity, which is the inelastic option, will generate more tax revenue. So that was the first bullet point. What about if the government's goal is to discourage consumption? So we mean which option is going to decrease the consumption more? Well, whichever one results in a bigger decrease in quantity is going to be the better option here. So you can see that on the graph, the decrease in quantity demanded is greater when the tax is placed on a good that is elastic rather than the good that is inelastic. And then let's link that back to the graph. QE to Q2 is a larger decrease than QE to Q1, so that means that consumers will consume less. And that's the whole answer. Let's compare this to the marking schedule. By the way, the great thing about NCEA economics is that it doesn't really matter how elegantly you write your answer. It's more about, did you say the things that you needed to say? When they mark, they kind of just look for the key points that you need to make, and they go tick, 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 yep, you did that, that, and that, boom, you get that grade. They don't exactly look and be like, oh, well, how well did you actually write this? Does this actually make sense? Did you write in full sentences? Is your spelling correct? Literally none of that matters. This isn't English, this is economics. You can literally just write in bullet points if you want. You could write vertically if you want. You could write back to front. So long as you write the things that need to be said to get the answer, then you get full marks. So if you struggle with wording your answers right, or figuring out where to even start with your answer, or don't know how to write because you feel like you might not say it in the smart way, or you feel like you're not using the correct words, don't even worry. Like, if you say the main things that you need to say, even if you start with the conclusion, it doesn't matter the order. Like, it doesn't matter as long as you just write down what you need to write in some capacity. Looking at part II, here is a sample answer that they've given, which is pretty much the same as ours. And then to get achieved, you have to say the government will generate more tax revenue if taxing inelastic goods. Or you could say it'll be more successful in discouraging consumption if demand is elastic. So that's just two sides of the same coin. So that's pretty easy to get achieved. But to get merit, you have to say the government will generate more tax revenue if taxing an inelastic good with reference to the area of the tax on the graph and QD decreasing proportionately less. So you say the reason that they collect less tax is because QD, quantity demanded, decreases less. Or you could also say that the tax will be more successful in discouraging consumption if demand is elastic with reference to QD decreasing proportionally more. So this is the same thing again, just two sides of the same coin. Also, you'll see that for merit, you have to refer to the graphs. Refers to graph 1, graph 2, and table 1. So you have to refer to all three. Basically, you just say like some of the numbers that are on the graphs and in the table. To get excellence, you say the government will generate more tax revenue if taxing an inelastic good with reference to the area of the tax on the graph and saying that quantity demanded decreases proportionally less. And then you also say the other side, so saying that tax will be more successful in discouraging consumption if demand is elastic with reference to QD decreasing proportionately more, and then referring to the graphs. So you can see that in our answer, we've hit all the marks to get excellence, and you can see what exactly you need to do to get achieved merit and excellence. Basically, excellence is putting in all the details and referring to all the graphs, and then a little bit less for merit, and then a little bit less for achieved. So I would highly recommend that you aim for excellence, you aim to remember everything, and see how much you can remember in the exam. Okay, so that was everything for this video on question 1 of the 2025 paper. We will upload question 2 soon, which is looking at tariffs. If you're studying for this exam, you might want to check out our playlist on 3.1, where we go over all of the key topics for this exam in depth, and we've got lots of practice questions. If you have any questions about what we've covered today or any suggestions about what you'd like us to cover next, drop a comment down below. Make sure to like and subscribe, and as always, see you next time for more big brain energy.